Hello, and thanks for joining me today. The topic that we're going to cover is the differences between FHA financing and conventional financing. You've probably seen or heard both of those thrown out, and a lot of times you hear FHA and equate that to bad credit, conventional to good credit. Simply not true. We're going to cover the 7 main differences between the two financing options and why selecting the right one for you may determine if your offer gets accepted or passed over. Hi, if you're new to this channel, I am Mike Spindler. I'm with Edge Home Finance, and I've been in the mortgage business for over 25 years, helped thousands of clients purchase their new home or refinance their existing home. And I'm glad you're joining me today. Okay, so I'm sure you've done research online and you're looking, and there's just a lot of misinformation out there, as I've stated in other videos, and trying to determine which financing type you should go with can be a headache because there's so much information out there. How do you determine this yourself? So I'm going to cover the 7 main differences between conventional and FHA financing and why both financing options are good financing options. It just depends on your individual scenario. So the first main difference is it does come down to credit score. So FHA, instead of saying FHA is for bad credit and conventional is for good credit, I say FHA is just more lenient financing. So it's not because you have terrible credit. It may be because you're trying to buy a home that pushes your debt to income ratios higher, etc. But the main point of difference is FHA does allow lower credit scores. You can get down into the 500s potentially for FHA financing. The down payment minimum 3.5%. If your credit score is below 600, it may be increased a little bit. But down payment percentages aren't really that different between FHA and conventional. Credit scores are one of the main differences. So you can qualify for FHA financing to purchase a home with a lower credit score. That is true. So with conventional financing, the minimum required guideline for credit score is 620, but in all reality, if you're looking at lower down payment, so 3% to 5%, you're going to want to see your credit score at 700 or above. For conventional financing. That's where we know we'll most likely get the approval in the automated underwriting system if you have credit scores above 700. However, if you have a pretty hefty down payment, there are options to go below 700 to get approved for conventional financing. Difference number 2, FHA allows for higher debt to income ratios. So before I get into what those are, percentages for FHA versus conventional, I want to explain what debt to income ratios are. So your debt to income ratio is any debt that you have monthly that shows up on your credit report. So minimum required monthly payments, not necessarily what you pay, the minimum required monthly payments that show up on your credit report, plus the new estimated house payment. So principal, interest, property taxes, homeowners insurance, homeowner association dues if you're in an association with a townhome, or a condo, monthly mortgage insurance, PMI, private mortgage insurance, mortgage insurance. It's referred to a few different ways. But all of those together, plus all the minimum required payments of debts that show up on your credit report, compared to your monthly gross income. So before taxes are taken away. So the debt to income ratio is the percent of the house payment plus all your minimum monthly payments that show up on your credit report compared to your monthly gross income. FHA does allow higher debt to income ratios. With FHA, you can go above 50%. So 50% of your monthly gross income can go towards your monthly debts and the new house payment. And sometimes in situations we don't really want to push it this far, but FHA can allow up to 57%. Where in relation, conventional financing is more strict with debt to income ratios. Conventional financing likes to see your debt to income ratios below 45%, but you can get approvals with conventional financing all the way up to 49.99%. Anything over that, so if you see 50% or above, automatically can't do it. So that's when we would look towards FHA. So for a borrower or a buyer of a new home who wants to push their budget a little bit more because they know, hey, I'm going to get a raise or I'm going to get a promotion here in the next year or two, so I want to push this now and be able to get into that house now, we can utilize FHA financing to go above 50% for debt to income ratios. Difference number three. The other main difference with FHA, so you have monthly mortgage insurance, which we'll talk about here in a little bit, with FHA and conventional, depending on what your down payment is. But with FHA, there's an added slice, and it's called your upfront mortgage insurance premium. So that's a mouthful to say. But the FHA does require, when you use FHA financing, you have the upfront mortgage insurance premium, and that amount is 1.75% of your loan amount. So not the purchase price, of the loan amount. So that can either be paid out of pocket, which is very rare to see anybody pay that out of pocket. It can also be financed into your loan. So when you finance that in, you don't have to bring extra cash to closing. That's just one of the things with FHA that they require, because they do. It is a little bit more risk with expanded ratios, lower credit scores, the more flexibility with the FHA program. That's one of the things that you have to pay with it. Conventional financing does not have that. Difference number four. So mortgage insurance. We all know, or we've all heard, that you're going to have to pay private mortgage insurance, or PMI, if you put less than 20% down. So that's true for conventional financing. FHA, if you're putting less than 10% down, FHA's private mortgage insurance, or mortgage insurance monthly premium, will be required for the life of that mortgage. So you'll never get out of paying it unless you refinance or sell the home. So with FHA, if you're putting less than 10% down, mortgage insurance is required for the life of the loan. If you're putting 10% or more down, then FHA only requires that mortgage insurance to be tied to the mortgage for 11 years, and then it drops off. Where with conventional, if you're putting 3% down or 5% down, yes, you will have private mortgage insurance, and you'll pay that monthly until you reach 78 to 80% loan to value. So until you have 20 to 22% equity in the property, you'll pay mortgage insurance, and then it automatically drops off. So that's one of the things with conventional. Eventually, you'll get rid of mortgage insurance. And then if you put 20% down or more, there's no mortgage insurance with conventional financing. Also, the other thing with PMI and mortgage insurance, between the two, typically mortgage insurance is going to be a little bit more expensive monthly with FHA than it is with conventional. Now, it all comes down to what your credit score is and how much you're putting down to determine what your actual mortgage insurance will be with conventional financing. But typically, it is a little bit cheaper each month with conventional versus FHA. Difference number five between FHA and conventional financing. So you're pre-approved, you get an offer accepted on a home, you get through your home inspection if you decide to have a home inspection, and then we're ready to have the appraisal done on the property. And I'll do a video about the difference between a home inspection and an appraisal, but basically an appraiser is contracted to determine the fair market value of the property that you're purchasing, to let you know if you're paying fair market value, if you're getting a good deal and paying a little bit under the market value for the home, or if the market value of the home is lower than the purchase price. So basically giving you an opinion of value for the property that you're purchasing. So both conventional and FHA require an appraisal to be done on the property. However, in addition to that appraisal with FHA financing, because it is a government-backed financing program for mortgages, there's also a health and safety inspection. We call it a mini inspection that the appraiser does when they're going through the house and completing their appraisal. So common things that you see with the health and safety inspection piece of it, what they're looking for is handrails going up and down stairways, smoke detectors, CO2 detectors, chipping or peeling paint is a big one. They want to make sure that the paint is sound in the property, and what is painted, be it a deck or exposed wood or even paint in the house, and that it's not chipping or peeling, because that could be a health hazard and a safety hazard for you. Broken panes in windows need to be replaced, things like that. When FHA goes out to a property and they do the mini inspection, they'll deliver the appraisal report back to the lender and back to you as the consumer, and it'll give the opinion of value. It'll list out the comparable homes that have sold in the area. And then it'll also list out if the appraisal is as is or if there are work orders on the home. So if any of those things that we had talked about, plus FHA has a big list, but these are the common things that you see once in a while. Let's say the home had a broken window pane and has some chipping and peeling paint. So the appraiser will mark that appraisal as subject to the repairs. They refer to them as work orders on the property. And then they'll give an estimate to cure. So just the appraiser's estimate of what they think it would take, what it would cost to remedy that issue. When a work order shows up on an appraisal, that work order, weather depending, needs to be completed prior to closing. And once that work's done, so let's say it was the chipping and peeling paint and a broken window pane. So once that window pane has been replaced and the chipping and peeling paint was scraped, repainted, and sealed, then the appraiser will need to go back out and do a final inspection on the property to ensure that work is done. Then they sign off on the appraisal. They say the value is as is, and we're clear to close. So FHA has that mini inspection tied to the appraisal, where conventional doesn't. So it's really rare. I've had some things called out on conventional over the 25 years that I've been in the business, but it's very rare for something to be called out on a conventional appraisal that needs to be fixed prior to closing. The one I can remember, I had one incident of this in the past year, and the appraiser did see some water damage in one of the rooms of the home, and you couldn't tell if it was fresh or if it was from the past. So the only thing they required is to have a plumber come out to the property or a contractor out to the property and offer a statement stating whether that is an active leak or if there are no active leaks in the property. So real simple to get that one done because it wasn't an active leak. We had a contractor come out, look at it, and take care of it. But that's probably in the last, I'd say, year and a half, 2 years. That was the only thing that I had called out on conventional appraisal because they don't really have that safety and health inspection. It has to be something that looks pretty serious that would impact the value of the asset, so the value of the home that the lender is investing in. That's a main difference, and that's one where when I said at the beginning of this video that it could determine if the seller is going to accept your offer or not. That's one thing that sellers are aware of when they're fielding offers. So if you have an FHA offer and there may be some bumps and bruises on the property that's being sold and it's lined up to an exact same conventional financing offer, that's where the seller may pass over your FHA offer and accept the conventional offer because they may not want to deal with any work orders or potential work orders that could come back on the appraisal. Difference number 6 between FHA and conventional financing. So we're all worried about interest rates when we're going to buy a house. And I get it. It's what calculates out your monthly payment, right? It's what your monthly payment is based on. So low interest rates are always good, right? They're always better than higher interest rates. One difference between FHA and conventional financing, and this is fairly typical. Some days it's not this way, but most days it is. FHA financing does offer a little bit lower interest rate than conventional financing. And when I say a little bit lower, it may be 1/8%, 1/4%, 3/8% lower than conventional. However, because mortgage insurance is a little more expensive with FHA than it is with conventional, a lot of that difference in the interest rate is washed out with the difference in the mortgage insurance. Not all of it, but a lot of it is washed out with that difference in the monthly mortgage insurance. But it is true, and you see it online when you're looking at interest rates between different programs. FHA typically does carry a lower interest rate than conventional financing does. Difference number 7 between FHA and conventional financing. So all of that said, those are the main differences. There's obviously a lot more, but it's more underwriting guidelines and things like that that you don't need to necessarily know about. That's something your lender, hopefully me, will walk through with you when you're getting pre-approved for financing. But the good news is when I complete a pre-approval, I pre-approve you for both FHA and conventional financing. So you always have both options. And then we line those up side by side. And you, because you're the boss, when you're buying a home, you're choosing the mortgage, you decide which one's better for you. So the good thing is sellers do a lot of times prefer conventional financing over FHA financing. Because of that stigma and that misinformation, you maybe saw that I addressed at the start of this video, that uh, people associate FHA financing with bad credit, conventional financing with good credit. So we always want you to have the options, be pre-approved for both conventional and FHA, so you can make the determination when you are submitting an offer to a seller which pre-approval you want to go with, or you can let them know that you're pre-approved for both. When there's other competition on the home, and this is something your real estate agent will guide you through, because they should be very in tune with the market and making offers. If they're not, you need a different real estate agent, but they should be able to guide you when you are going through that process of making an offer on a home, to say, yes, we need to use conventional this time, or because there's 2 or 3 other people who are also you're competing against who submitted an offer on this property. Or they could say, this home's been listed for 2-3 weeks, there's no offers accepted on the property, there have been no offers, so these sellers are going to be a little bit more hungry to accept an offer. If you're the only one that comes in, you can take advantage of the benefits of FHA and use that as your offer, FHA financing for your offer. So that's the main difference. And this is probably with a lot of lenders. I always pre-approve all of my clients with every option that's available with them, and then they are the boss. They're the ones that decide which way they're going to go with the financing. If you found this video helpful, or if you have any other questions, please let me know. If you have any topics you want me to cover in videos, also, please let me know. I'm happy to do it, and it may be something I'm not thinking about that you have a question about. So that would be really awesome if you let me know. But if you ever want to set up some time and talk to me directly, you can give me a call or send me a text at 612-590-8623. I'll have my other contact information in this video below, so you can reach out by email or through my website. But look forward to helping you. Hopefully this brought you value. Don't let the process be too complicated or overcomplicated for you. Buying a house is fun. Let's get the mortgage stuff out of the way so you can focus on the fun things and purchase your new home. I'll be back with more videos in the future, and I hope to see you there. Thanks.